Hello and welcome to joining us live today on the Invest Lab for one of the most interesting episodes we're going to do. Gabby's too lost in the dance. She can't get out of the tune.
I can't even speak.
Awesome. We're in for a big one today. So today we are going to be covering. So before we get into that, thank you for joining us live. For those of you who are here, let us know in the chat. Let us know that you're here because we love to see you here. We love to see the community here every week. We like to say hello. We love you guys to get involved. The reason we do it live is so that we can be here with you. So it's nice to know you're here with us. So if you are here, let us know. Say good day in the chat. We are joined today by an absolute menagerie of experts. We've got Sean Simpson, head of property. We've got Jason De Silva, head of client success. We've got Callum Rhodes, head of Dashdot finance. And you've got your friendly neighborhood spider hosts, myself and Gabby. And today we're going to be covering a topic that is very, very important and also very, very underspoken about. We're going to be doing a Portfolio Acceleration Masterclass today on how to use strategic selling as a booster. You often hear us talking about, or you hear people talking about buying the right property in the right place at the right time. But what about selling the right property in the right place at the right time? And in fact, how might that be a value add to your portfolio so you can achieve your goals faster? Because most people think of selling. When most people think of selling, they think of something they're going to lose. I had a property, I sold it, I got rid of something. But what if selling could actually be the secret to helping your portfolio grow faster, better, stronger, and helping you to achieve your goals easier and in less time? So with that kind of preamble, how is everyone joining us here today? How are you guys?
Very good. Exciting.
It's an audio-visual experience, so you can do the audio with the thumbs up. You can do the visual with the thumbs up. The audio is good too. Good.
We can dance together if we want to do that.
We can all do a little bit of a dance together for sure.
I think we'd probably lose some of the viewers if I started dancing, so I'll just stay still for the time being.
It's an after-hours thing, is it, Cal?
There you go.
Nice. Well, I'm
Awesome.
really excited to get into today. Gabby, do you have anything you want to add before I kind of continue my waffle rampage?
Yeah, so I think, like, Goose, I'd love to hear more about like why we are here and why this conversation is so important. Because I think a lot, I think back to starting Dashdot and through the 6 years that this business has been running now that we've been serving people in this capacity. And things change all the time and so much changes. And I think we really, as strategic investors, need to be adaptable to what is happening in the world around us, what changes in terms of strategies that we need to follow, what happens in the markets that we're invested in, what happens with our personal financial situation. We really need to constantly be reviewing everything and adapting and finding the right path forward. So, and as you said, selling is something that in this side of the internet/world and services of helping people to buy a property, a lot of people don't often talk about when's the right time to sell. Obviously, they're sellers agents, but you're not going to get the guidance of this is how you can think about if you should sell that asset. It's kind of a gap in the services world of helping people to realize and learn and really have that knowledge of assessing your assets and assessing your portfolio and figuring out, do I have something that would be better off being sold?
Yes.
So,
yeah, I can definitely start there. Why don't I start first by let's just kind of frame up a little bit. What do we hope to get out of the next 2 hours? So we've got 2 hours here today. This is going to be a big one. It's going to be a big session. Maybe we get it done in less time, but I doubt it. Just frankly,
we're very concerned. We were just reviewing all the content, and
so
there's so much to get through. Yeah,
there's a lot to get through. But really, the kind of key things we want to get out of today is why should you consider strategic selling? Now, selling is not something that you must do, but it is something that a lot of people don't even consider. So we're going to talk about why you would consider selling, when it might be appropriate. So we're going to discuss why, like how it fits into a kind of a strategic framework to sell. When would you know if it's time to sell? So we'll go through a decision-making framework plus market metrics to look at. And we're going to talk about how you would do it if you wanted to do it. Now, within that, there are layers and layers and layers and layers of stuff to unpack. And so what we're probably going to find in this session is that we're going to struggle to cover every detail and nuance around this topic. And so the goal for us with this session is to empower anyone who's watching this to be able to answer those three things. Why should you consider selling? How would you know when it's time to sell? And if you decide to do it, how would you do it? And if we can do those three things throughout this episode, then I think that's going to be success. So back to kind of your point there, Gabby. Why are we even talking about this? Why is this a thing? Because the prevailing wisdom over the last 30, 40, 50 years in property investment or property ownership generally is just buy and hold forever, never sell. And that, I think, is a function of lack of information. And really, you don't have to go back very far to understand how information has shifted and changed our approach to property and why we need to continue to evolve to the times. If you even go back as just the year 2000 or even maybe, 2005, but let's use the year 2000, which is not that long ago, by the way. It's not really that long ago. In the year 2000, the ability for you to buy a property interstate was almost non-existent. I don't even think, don't quote me on this, but I'm not even sure if realestate.com.au was up in the year 2000, right? And let alone, how would you, if you were living in Melbourne, how would you know if Dubbo was the right time and place to buy? How would you even work that out? How would you even have the information to know that that's an appropriate place to invest? And even if you did know that that was an appropriate place to invest, how would you find a property? Would you drive there or fly there and start looking around? How would you do that? And so necessarily access to information has changed quite a lot. And it's necessarily changed our approach or how people should approach it. I remember when we started the business 6 years ago, the concept of just 6 years ago, right? Not the year 2000, just 6 years ago, the concept of investing interstate, borderless investing was a brand new idea. And as we were starting the business and we were growing the business, introducing people to this concept of, hey, did you know that you can actually find places that you don't even have to go to them, right? You can actually buy properties interstate and build wealth in a really strategic way. Now, access to information has continued to change everything. And as we started the business, we first started by working out how do we find the right places, right property, right place, right time. And then we said, okay, well, the right property, right place, right time, that's good. But what about, how do we know if it's right for the individual? So then we started developing the portfolio planners. Then we started going, okay, how do we know where markets are going to go? Now, with an increased access to information, you can increase the complexity and sophistication of your strategy to make sure you're getting the most out of it. Now, I remember once upon a time I heard a quote from John McGrath, no relation to me, by the way, whose very simple and frankly archaic philosophy on property was buy property, hold it for 30 years. That's the secret to property investment. The challenge with that is that actually doesn't necessarily help people to achieve their goals faster. If you buy a property and hold it for 30 years, almost certainly you're going to make money, right? Almost certainly, unless you've bought, a shack out the back of 500 kilometers north of Broken Hill or something like that, right? It's you'd have to go pretty wild for you to not make money over a 30-year time horizon in real estate. But is that strategic, or is that just buying properties and hoping for the best? I heard a story recently. I spoke to some people. They'd just spoken to a property investment company of good repute, by the way, who said to them very simply, you can buy 3 properties and then you'll be stuck. And that was the end of the conversation. And it's well, what if that didn't have to be true, right? What if that didn't have to be true? What if there were better ways to allocate capital? What if there were better ways to strategically think about your portfolio so that you could move faster and so that you could achieve your goals sooner? Now, this kind of goes back to a core point, and at risk of kind of soaking up too much of the time here, I think it's very important to kind of just bring this back to a point. Why do we invest? Full stop, why do we invest? So number one, we invest because we have a broken monetary system that doesn't allow us to store our economic energy in our political currency. It no longer works. And we'll put a link in the episode. If you want to know more about that, go back and check out the first episode we did this year. I can't remember. It's the thumbnail is what is money? Yeah. So we'll put a link to that. If you want to know more about how the monetary system is broken and how that is forcing us in today's age to invest, then I suggest go there. But also the other reason that we invest is because what we want to do is we want to create a life of freedom, choice, and abundance. We want to create a life where we don't have to work if we don't want to work, where we can spend our time and energy on the things we love most and really live life to its fullest potential in whatever way that plays out for you, whatever that vision is for you. And so if that is the goal, if that is the objective, to get to a place where we can spend our time and energy in the ways we want, not the ways we have to, then surely the question we should be asking is not how many properties should I own? It should be, or, how many properties should I buy, or any of these kind of things. It should actually be, what strategies can I deploy in my portfolio or in my life that are going to help me get to that end state sooner so I can really maximize life? Because at the end of the day, we only have one life. We have a certain amount of hours on this planet. We don't know when our time is going to be up. For some people, it's long. For some people, it's short. But one thing is for certain is that it's uncertain. We never know. And so the objective should be to get to that destination as quickly as we can without exposing ourselves to unnecessary risk, so that we don't risk losing it all along the way, so that we can live the life that we want. And so with that in mind, we must necessarily be open to questioning new ways of thinking about portfolio construction, new ways of thinking about portfolio management in such a way that we can reallocate capital potentially in ways that are going to unlock new opportunities in our portfolio. Before I continue waffling on, did anyone have anything they want to add to that?
I think just on the how many properties thing, I think that's a really good point, because a lot of people are poisoned by media, and there's lots of other people in the industry, quite well-known people that will, prize this owning 100 properties or 50 properties or 60 properties or whatever it is, which for starters, there's certain financial limitations that make that very, very challenging for normal people, for starters. But even if you can get to that point, if the end goal is freedom, I don't know if anyone's looked after a portfolio of 60 properties, but I would not say that's getting a cheap goal. Yeah. So I just think it's a really good point to dwell on, because there is a lot of that in the industry about sort of people really encouraging these, that would be the end goal, which I think is really incorrect. So.
Yeah, 100%. Just a quick put on that, because I think it's a very good point to make. Like, you could buy cheap properties, right? You can buy cheap studio apartments in all kinds of random places. If the goal is number of properties, I think you've kind of got your metric wrong. I actually met someone just after we'd started Dashdot who owned 196 properties. And she was actually looking to work with Dashdot she had 196 properties. 196 houses, by the way, not even apartments, 196 houses. But she'd bought them all, just like the strategy was find cheap houses with the highest possible yields. That was the only strategy. And so whilst she had a really good passive income from that, she had 196 properties to manage, 196 tenants, 196, that's not freedom. That's a different type of job. That's what that is. Yeah. Right. So how do we get there in the best possible way? So, okay. Anything else that you guys want to add to this?
No. I'll just jump in. I'm going to attempt to be timekeeper today because we've got so much to get through. But I've just got a list of what I really want people to get out of this session. So if we get through everything, I think people will walk away with the ability to assess their own portfolio, assess each property in the portfolio, assess each suburb in your portfolio, determine if selling is right for you, determine if there's a better way for you to take profits rather than selling, and to understand how to reinvest effectively. So those, I think that's 6 things are really what I'm hoping that everyone walks away with at the end of this session. What we are not saying, which I think is really important to emphasize, it's not sell everything.
Yeah.
This is a strategic conversation of how to make better decisions for your portfolio so that you can move towards your goals faster. Goose, did you want to elaborate on that a little?
Yeah, I mean, it might even be useful for me to kind of give the 10,000-foot overview, and then we can kind of drop in and start to sink into some of the pieces.
Yeah, cool.
Okay, so why would you consider selling? So let's say you've bought 3 properties or 4 properties or 5 properties. I mean, you got to ask yourself, why would I sell? You bought a property and maybe it's gone up. If you've worked with Dashdot, maybe you bought a property and it's gone up by, 200% or something like that. Great, you got this winner. That's awesome. Why would you consider selling? Well, there's several reasons you might want to consider selling, and they're all really. I'll stress the point that you made, Gabby. You should never really have to sell unless you've A, bought the wrong property, B, there's been an unforeseen change in the market, or C, something's happened in your life where you need the capital. Right? They're the only scenarios really where you'd be in a position where it's okay, I proactively need to sell. Right? Otherwise, if you've bought good properties in good locations with good fundamentals, then the choice to sell is actually really much more of a strategic one. And there is no one-size-fits-all solution to this, and it's going to be very situationally dependent, which is why it's important to approach this with a strategic mindset. But some reasons you might want to sell. You might own 3 properties, but you might be stuck on borrowing capacity, or you might be stuck on your savings rate, for example, and you might not be able to progress to the next property. Maybe you've got properties you bought low in a cycle, and the values have accelerated quite a lot. You've made a lot of returns, and now you might be looking at the market and actually asking yourself, okay, is the market going to give me those kind of returns in the future, or have I captured most of the growth? And maybe should I consider reallocating capital into a different market? Right. These are kind of some of the key things. So really thinking about, is it better to capitalize on that market return now? Or are you prepared to hold through to another cycle? Are you stuck in your portfolio? Is there a way that selling some properties down can help unstick your portfolio and get you to the next stage? These are the kind of core reasons that I think people should consider selling. And it's very interesting because what a lot of people don't do is they don't associate selling with portfolio growth. But in a very practical sense, and again, I'm going to touch on sort of all of the areas that we might want to dig into. And then I promise I'm going to talk less and give everyone else more floor space, because I think there's a lot of knowledge here in the room. But like one example of how this might play out for someone is perhaps when you started your property investing journey, you bought in your own personal name. And maybe there was a good reason to buy in your own personal name. Maybe you bought in your own personal name because the property was going to be cash flow negative and you wanted to claim the negative gearing tax benefits and all that kind of stuff. Maybe you bought 3 properties in your personal name. Maybe and then maybe now you've found the edge of your personal borrowing capacity. Maybe you also don't have the ability to continue to save. Maybe you've got enough equity in your portfolio, and maybe you even have borrowing capacity available, but maybe you don't have enough surplus cash flow in your portfolio or your savings rate to be able to afford to buy another property. Now, the question then would be, do you just sit on those 3 properties and just wait another 5 years or something like that, and eventually they'll become cash flow positive and then you can do something? Or might that be an opportunity to consider selling the properties and reconstituting and restructuring your portfolio? And in this scenario, you may be able to sell down 3 properties, then reallocate that capital in such a way and in different structures, which we can only talk a little to some degree about, that could allow you to go from 3 properties to 5 properties. Because we've talked a lot about on this podcast, and maybe Gabby, if you could link to the appropriate episode where we talk about the theory of constraints. We talk a lot on this podcast around getting stuck, and so a lot of people ask themselves, okay, well, how do I get there? Now, there's different ways to get there, but one of the ways to get there and one of the ways to not get stuck is to understand when you may want to sell down some assets that are holding you back. I'll give an example. I spoke to someone the other day who's looking to become a Dashdot client. And one of their issues, their constraint in their property portfolio was their savings rate. They didn't have much savings rate. They actually had 7 properties, but they didn't really have much savings rate. And they had no strategy when they bought the 7 properties. They just went out and just bought a bunch of properties. And one of those properties, they'd owned it for 10 years, and it was worth exactly the same as the day they bought it. It was leveraged up to 95% or something like that. But it was worth the same as the purchase price they bought it 10 years ago. Now, that was also costing them $20,000 a year in holding costs. So whilst they still had plenty of borrowing capacity, they actually couldn't use that borrowing capacity because they couldn't afford to take on another property if it was going to have any kind of negative cash flow element to it as well. So simply by selling down an underperforming asset, they were able to then not only get back the debt, so they had about $595,000 of debt on that property. Not only do they get back that debt that they can redeploy, they also get back the negative cash flow that they can redeploy as well. So they got back $595,000 of debt and $20,000 of cash flow, which could then be reallocated to buying a better performing asset that's going to set them up for the longer term. So these are the kind of reasons we might want to think about selling. And we should be thinking about it with that viewpoint. And by the way, let me venture into some other examples, because I think examples are useful when we're talking about a topic like this, because sometimes it's kind of hard to get your head around. And we are going to go through some decision-making frameworks, and maybe we jump into that next, Gabby. So maybe you want to get that ready because I think it's a good stepping stone. But selling is not always going to be the answer, and it really is situationally dependent. So speaking of market growth, actually, you know what? Let's bring up the market cycle timing slides. We'll just we'll just quickly talk through those. Right. So property markets don't go up in a straight line. They tend to, and every market is different, but they tend to go up in a staircase type pattern. So they tend to go through a period of protracted nothingness, right? They go through a kind of like a stagnation kind of a period, potentially with a bit of a slump. Typically it's somewhere between 0% growth and a bit like maybe negative 10% growth over a 10-year period or something like that. And then they go through a significant upturn. That's typically how it plays out. You even see this playing out in capital city suburbs, but on different timescales. And so if you find yourself in a position where you've bought, let's say low, like where those green circles are, it's a good time to buy. Then if you go to the next slide. Now, obviously, getting to a point here where we're at a transition point in the market, that could be an interesting time to sell. But it's not always going to be the right time to sell. And understanding how to ask yourself the questions around when it is appropriate for you or not is really interesting. Now, I want to give a couple of examples for this, again, because I think it's helpful to kind of see how this plays out in real life. So as part of our process, in fact, maybe go even up to the portfolio growth system slides. We have a 4-part system that we use with all of our clients. It starts with planning, financing, acquiring, and optimizing. Right? And so as we look at the optimization phase with our clients, one of the things we look at is not only like the planning phase is how to build a portfolio plan. We build a plan for people. Then we need the finance to build the portfolio. Then we find the right property in the right place at the right time. But the optimization piece is also just as important. In fact, I would argue it's even more important overall to know how to think about this in your portfolio. Optimization for us also means giving our clients advice on, hey, we think that this market has seen most of its growth. And so if you want to consider selling, now might be a really interesting time to sell. Now, that could be after market has grown significantly for a couple of years. And it doesn't mean that it's going to decline necessarily, but it might just be that the kind of sharpest, steepest growth curve is behind you. And maybe you've captured most of the growth in that suburb. And maybe it's time to consider. Now, I mentioned examples. So there is a region or a pocket in Australia where a lot of our clients have seen significant growth. And I'll give you 3 examples of clients that we spoke to where we all in the same area where we said, hey, you've made significant amount of money here. It might be time for you to consider selling. One said, sell all. They own 3 properties in the area. They said, sell all the properties because I want to repurpose all the capital and I want to move it to the next best spot because I just want to go as fast as I can. Another one said, sell 2, keep 1, right? Because I want to sell 2 and I want to reallocate that capital, pay down my home loan, and then I want to do a debt recycling strategy to move that capital back out of my home. But I'm happy to keep 1 because I like that one because it's in a great spot. It's near the beach, all this kind of stuff. It's good. I want to keep it. Then we had a third client who only had 1 property in the area, but and that property was yielding at 8.8%. It was held in a trust, pigeon paired with a unit block, and it was in a really great location in that suburb. And yeah, cool. The market was potentially softening in that specific suburb, but the opportunity was to even not sell it because it was a great quality asset in a great quality location. And even though maybe the best growth was behind it for the near-term future, that asset wasn't going to hold them back. It wasn't going to stop them from progressing in their portfolio because the debt was siloed in a trust. And so 3 different scenarios, same general area, 3 different outcomes. And so understanding how to make these decisions is really critical. Sean, Jason, do you guys want to add anything into this?
I was just adding, you touched on. Sorry, you go, Jason.
In future, I'll pick 1. Jason, you go.
Good idea.
Yeah, I was just going to say that's a really important point, Goose, especially around the optimization side of things, because a lot of people have this perception where they treat property like a passive asset, and it is to some extent, but having a look at your portfolio to see on a consistent basis, whether it's a 6, 12-month basis, what are the strategic moves I can make here to optimize my return? Because it can mean significant hundreds of thousands of dollars of lost opportunity costs if you aren't looking at that on a constant basis, looking at where the properties are at, but also looking at, are my rents in the best position? Could I do a renovation to maximize the capital position of the property? I think it's a really missed point, and it's good that we're taking a very proactive approach here with our clients and helping them on that journey, because otherwise it can lead to a pretty poor performing asset, even though you've bought property potentially really well at the start.
Totally. You know what? I like to use examples because it helps I'll give you a personal example. So Gabby and I own a property, and 2 years ago, the bank valuation was about 600 grand, like 597 or something like that, right? It was about 600 grand. And we did nothing. We didn't refinance it. We were like, all right, awesome. That's good. Then late last year, we thought about selling that property. We're like, you know what, actually, let's maybe take some profits out of that asset. And then we went, but the market had changed. We'd missed it, right? We actually hadn't paid attention. We'd actually missed the market signals, and the appraisal was 410,000, and we went, well, all right. So if we'd sold it, if we'd done something with it 18 months prior to that, we would have had a nearly $200,000 difference, right? And so thinking this through is really valuable from a profit-taking perspective. And by the way, I'll just quickly talk about this. There's two different types of profit-taking that I can think of, right? There's either selling down your asset, but also refinancing equity out of a property is also profit-taking. And I think we'll dig into that a little bit later. But you can take profits by refinancing equity out, and that has a cost to it as well. It might cost you 6% a year. So if you take $100,000 of equity out of a property, you're taking profits. It's costing you 6% a year to have that. So over 10 years, it's going to cost you maybe 60 grand on a 6% interest rate. And then if you sell a property, that's also going to have costs associated with it as well. So all profit-taking has costs associated with it, but there's also multiple ways to consider taking profit based on whatever's going to work for you at the time. But Sean, do you have anything to add?
No, I was just going to say, you mentioned quickly that selling is about growth. I think that's a really important mindset for people to take, because a really good example, like you said before, is a lot of people, like probably the most common thing that we'll see is, let's say everyone's incomes have stayed the same throughout their portfolio, is you may have acquired one property, it's grown a lot, scraped all the equity out of it, you've gone, acquired property number 2, and you're now at a point where you cannot sustain any further cash flow. So in those kind of scenarios, there is literally nothing that you can do to keep going other than start to look at making strategic decisions. So quite often, if you're looking at a whole portfolio's growth, the people have seen something like 10%, then 20% over their portfolio, then 15%, then 10%. So they're still growing. The portfolios are still moving forward. It's still a positive outcome. But if we can reallocate some of that capital back into a market that's about to do the same 10, 15, 20 again, it's like re-accelerating your whole portfolio's growth, which I think is just phenomenally quicker than the traditional sort of thinking of, hey, just buy properties till you can't afford to hold anymore, and then just hold on to them until you get to your goal, which is a lot slower. So I think reframing it to be about growth, about re-acceleration, and being a positive thing is really, really important for people to sort of consider.
Yeah, 100%. And it's not even just the, like say that reallocation thing is important, but also if you're in a market where it may stagnate for a period of time, like you've got a choice between getting better returns somewhere or flat returns. Over a long time horizon, sure, that might work out just fine. But one of the other points that I'd like to make there, can you do it quicker? Can you get to your goals quicker? One of the other points that I'd like to make there, based off the back of what you said, is sometimes a property investor will buy a property, it'll go up in value, they'll harvest all the equity out of it, right? So they've taken all the equity out of it, and then they might also go, okay, now it's at a point in the cycle where perhaps actually it would make sense to sell. But if I sell it, I might even make a loss on that property, because maybe you've taken all the equity out of it, and maybe selling it would actually cost you, I don't know, 30 or 50 grand in costs to actually get rid of that property. You might be like, well, why would you sell? Oh, because I'm going to lose money. I shouldn't sell it. Well, maybe you've already taken $150,000 or $250,000 of equity out of that property and redeployed it to buy more properties, and that's already grown for you. And so, in fact, you still may have a reason to sell it, because even if you sell it as a loss, if it is stopping you from borrowing, you may have $300,000, $400,000, $600,000 worth of debt sitting in that property. That debt can be reallocated too. That debt is a resource. You may have negative cash flow on that property of 10, 15, 20 grand a year. That's a resource that can be reallocated. And so sometimes people get afraid of selling a property when they're going to make a loss, forgetting that they've actually already taken them. They took all the profits over the last couple of years. Now it's actually just time to release a reservoir of other available resources because you've got 3 resources in your portfolio: capital, debt, and cash flow. And so in that scenario, you may have refinanced all the capital out. So that maybe there's no capital left in that asset, but you still have debt in that asset, and you still have cash flow in that asset, right? So, and that could be relieving negative cash flow. And so you can reallocate those assets back into your portfolio to make better decisions as well.
I've got a really interesting example to share just on that point. So just in my own portfolio, I know I've done a few podcasts, but I've spoken about the illustrious off the plan apartment that I bought. In the last year, there was last 2 years actually, there was a strategic opportunity to be able to utilize a bank valuation where the bank had valued the property substantially more than what it was worth. So I bought it for $390. The bank valued it at 760,000. The property hadn't grown for 5 years already. So I saw that as a strategic opportunity to take that capital and reallocate it to invest in another 3 properties. So I bought 1 property with that, used that property to buy another property, and then used that property to buy 1 more property. And those properties grew by double the amount of equity I'd taken out from the portfolio. And when one of those properties peaked, I essentially sold it down and used that to get rid of the apartment debt. So it actually cost me $250,000 to get rid of the apartment. But what it had created was less negative cash flow, because it was costing about $30,000 a year to hold, getting debt out of my personal name, which allowed me to continue to move my borrowing capacity forward, and created an opportunity for me to add more properties to that portfolio, utilizing the additional borrowing capacity and negative cash flow that had been gained. So pretty extreme example, but it created a lot of value in the portfolio long-term for the right risk appetite, I would say.
So you basically took an underperforming asset, took the opportunity when there was because bank valuations, a lot of people, there's always going to be differences between bank valuations and sales prices, right? And so bank valuations are real, because that means the bank's going to give you that money. So you took 1 property, you turned it into 4 properties, and then sold down one of those properties so that you could afford to sell down the other one that was selling at a loss. So you ended up with net 2 properties, basically with the house's money.
Yeah.
That's awesome. That's great. That's awesome. Okay, so are there any other reasons that you guys want to talk about around why should people consider selling? Like, we'll get into the decision-making framework in a second, but why would people consider strategic selling in their portfolio?
I think looking at selling as an opportunity to manage the theory of constraints is a really interesting approach, because in practice it can pretty much alleviate any constraint, whether it's capital, borrowing capacity, or cash flow, based on how you're looking at it. So being able to assess your whole portfolio on that side of things strategically as an investor is really important, but also looking at whether there are any personal life goals as well that you're hoping to achieve, whether it's paying down your home. Like, we've had quite a few clients now as we've gone through this portfolio review journey, actually sell down their properties and pay down their home. And that creates a few things. One, it creates more security now, because it allows them to take a more aggressive approach in building out their portfolio, because there's less discretionary money being used on housing, but also looking at whether there's additional, like, we've got clients that have sold their properties to invest in business ventures as well. So looking at it holistically from a strategic perspective, but also what your short, medium term, and long term goals are, could be a really cool way as well.
I think it's hold that thought, Callum, because I'd love to get your opinion. But I think what you touched on there is really, really interesting, Jason, because it's one thing for us to think about selling as a way to accelerate your portfolio and build a bigger portfolio. But what about actually the goal? What about actual, why do we invest? Right. And so, I can think of this, you and I, we're familiar with many of the scenarios, right? But I can think of one scenario where some clients of ours bought 3 properties, made a ton of money. They didn't have any borrowing capacity left. So they had a lot of equity built up in these properties, but they couldn't really go any further at that point in time. But selling down those assets was going to allow them to buy another 3 or maybe 4 properties, and also take their family on a round the world trip. Right. So one of their big goals was they wanted to spend more time with their family and do all that kind of stuff. Right. And they wanted to and so they were like, this is awesome, but rather than just plowing it all back into investing, you know what, we want to enjoy some of this along the way. So not only are they able to reallocate that capital into markets where they're going to get better returns, because they've seen most of the growth in those locations that they're in, they're actually, I think, going to be able to potentially buy 1 more property than they had originally, because they're going to be able to lower the LVRs that they're purchasing with, spread the debt in a different way, and think about restructuring in a different way that's going to allow them to go from 3 to 4. But in addition, they're actually going to be able to take their family on a round the world trip. Their kids are at that age now, I think, around to the sort of 12, 10, 8, between 8 and 12 years old. So they're old enough to enjoy everything, but just young enough to still actually want to spend time with mum and dad. So it's this great opportune moment to go and really cement some real life memories with the family that they would never have been able to do before they started investing. So they get to get the best of both worlds. And obviously paying down your home, doing all these other things, these are really massive life goals for people that people can achieve and still leave chips on the table to keep investing.
I think that's really important, Goose, because it also re-emphasizes why you're investing, because obviously investing is a delayed gratification. You do have to take a long-term view, but if you're able to enjoy those wins along the way, which I've started to do personally as well, it kind of brings you back to center on why you're actually investing and what you're doing it for. And you're enjoying some of those little wins along the way, as opposed to just taking everything from the portfolio, using it to build more, continuing to work hard and build it out without really seeing how close you are getting to that goal.
100%.
I think all those emotional reasons you guys mentioned there, it's another critical thing that I see as a constraint in the psyche of a lot of property investors. It's the ego of it, and harkening back to what Sean you said about the number of properties. It's another constraint people hang on to that they probably should dispense with in terms of whether they should sell. It's like, oh, it's the number of the properties, and that ego can be holding you back from making the decision, because you want to be able to go to the barbecue and tell your friends that you got 7 properties versus maybe a situation where you should have 3, and that's a far better allocation of capital.
Yeah, 100% agree with you. And I think like that mindset shift from like property accumulator to capital allocator is a really significant mindset shift, because not only is it allocating the capital of capital, but it's also the capital of debt, or the resource of capital. It's also allocating the resource of debt, allocating the resource of cash, allocating the resource of time. In the example that I gave earlier, where the woman I met, she had 196 properties. She had like a psycho portfolio, but she hadn't got the time, right? So she's got the resource of time and focus, energy, and really thinking that through. More is not always better. You want to have some diversification, but yeah, getting past that ego and then shifting your mindset from property accumulator, how many properties can I own, to capital allocator or resource allocator, such that it's going to serve your broader objectives in life and you build the life that you want. I was listening to a podcast the other day, just a little side quest here, so we're just going to go a little bit off track. But there was this great quote in there. Not desiring something is as good as having it. And I was just like, oh man, that is so good. Right. But also it's like such a profound kind of point to make. And the other point there was that that this guy made was that most people pursue success so that they can achieve happiness. So they think that what they need to do is they need to make more money, get more things, build more stuff, build more equity, do more whatever, so that they can then go and have more time and be more and have more happiness, right? And happiness usually translates to more time to do the things you want to do with who you want to do them with. And it's like, well, why don't you just draw a direct line from where you are now to happiness? And you may find that there's a whole bunch of stuff you don't need to go through in order to get there, and you could just go straight to happiness. And so it's a very different way to think about it, and one that is, I think, much more mentally and emotionally and spiritually healthy, rather than like, how many things can I gather and how can I improve my status? How can I play a status game at the barbecue? Sean, do you have any other points on why should people consider strategic selling before we start to go through the when?
No, I think we get into it. I think other than the fact that I'd say the importance of this, unless you are going to indefinitely increase your income forever, or you're getting sent mysterious lump sums of money, you need to understand how to strategically sell, because you will get stuck at some point. So this is incredibly important to understand how to effectively do this. Because if that's your case, then go nuts, buy as many properties as you physically want until you don't have any time left. But for the most of us, especially early on in a portfolio, this is critical to get right, because in the early stages, getting this right and getting this wrong is decades of difference in the back end. Getting this correct, getting a lump sum of capital out of your first fund, reallocating, going from 1 to 3, 3 to 6, whatever the path is that you follow, is incredibly important, or you will get stuck.
I think it's a really good point, because like, some people have the ability to continue to increase their income, like potentially some business owners and stuff like that. They tend to have more, as the business grows, their income grows, all of that kind of stuff. And there tends to be a little bit more leeway there. But for the average person who's an employee, the probability is there's going to be an edge. And now there are things you can do to extend your capability. So you can think about structuring and this and that and the other. And there's a whole bunch of stuff you can do to get beyond the kind of initial thresholds of barriers. But even then, you will find a point where it's like, okay, there's still an edge somewhere. There's still a point. There is no, like, unless you can continue to increase your income. If you have a job, right? If you're an employee, then there is no hack for you to get infinite borrowing. It doesn't really exist, right? Now, but there are ways to play the game differently, right? So using structuring, using a different using different strategies, the capital reallocation can really matter, because, for example, and not financial advice, but if you have a If you have a trust and that trust is running at an operating profit, then you're able to effectively silo debts into a trust. And we can maybe talk about that a little bit later. But one of the ways that you can get that asset or get that trust into a profit is by selling down another asset, reallocating the capital into an offset account, decreasing the cost of debt, increasing the positive cash flow, and getting into a net operating profit, which then means the debt can be siloed, which then can actually unlock more borrowing capacity and allow you to keep going, right? So there's a bunch of ways in here that this makes sense, particularly if you're not someone who can just continue to increase their borrowing capacity. Gabby, you got any points you want to make before you get into the framework?
No, I was about to call time on. We need to move on to when.
Okay.
I have actually just all week basically been working on this session, but we put together a downloadable for anyone that's watching, as well as all of our clients who get this as well. But it's the Strategic Sellers Toolkit. So we're going to go through a lot of resources now in the rest of the session, and we've just put them all in a folder basically, and you can have access to them. And if you have the capacity now, I'd recommend jumping in there and opening them so you can follow along yourself. There's some guides and PDFs, but then there's also spreadsheet templates so that if you want like running your numbers, which we'll get to a bit later as well, you can follow along as you're watching this as well, or you don't have to, but all of the resources are there. So Goose, Sean, did we want to go through the selling considerations flowchart?
I think we should. I think there's two things that we should cover off here because if you've gotten to this point and you're like, all right, cool, I got my head around it. There could be an opportunity to sell and I need to start thinking about this. So we've covered the why you might consider it. And I would just reemphasize, consider it, right? Because this is not you got to go sell your properties. This is not that. It is why, when and why and how might you consider it? So let's go through the framework so we can start to give people a pathway to start to effectively the algorithm that we would use internally to work out, okay, is this something we should consider selling? So everyone can do this at home. And it's amazing that we've got this Strategic Sellers Toolkit because it's giving people a lot of really great capabilities. Sean, do you kind of want to lead on this or do you want me to lead on this?
Yeah, I'll play a bit of ping pong on it, I guess. We'll see how we go. Cool. Well, I guess step one, we've got, have you owned the property for 12 months or longer? So again, I'll say that this is the advice is general in nature. What we've tried to do here is make it as simple as possible so that if you're playing at home, never work with Dashdot, you can still work through this and at least come to an understanding of just the framework to think through whether or not you might consider selling. So 12 months or longer, I'm sure everyone's familiar with the fact that you get a CGT discount after 12 months. Now that again is not saying that there's not situations that you may want to sell within 12 months, but generally speaking, obviously you don't want to make I'm sure there'd be angry accountants if we'd recommend people sell within 12 months. So it's a good way to minimize your tax outgoings from your profits. Then we move down to, has the property experienced significant growth?
Let me just woo up on that, right? So just to make sure that we get woo up. So there's the CGT discounts consideration, but also what's really important to remember is property shouldn't be considered a get-rich-quick scheme, right? So, you may have bought a property and look, and we see this happen pretty commonly, actually. You buy a property and then within 12 months, it's gone up by 30%, right? It happens. You get a bank valuation, it's gone up by 30%. There can be a propensity if you're an emotionally volatile person to be like, oh my God, I need to take that money off the table now. But just slow down and remember that property investing is a long-term game. So yes, you can make some money in the short term, but obviously you're going to give up more of that in CGT if you sell in less than 12 months. So realistically, you should be making investments. I think broadly, right? Your investing timelines just in stuff generally should be 12 months or longer, not short-term investments. So kind of just having that mindset going into it that if you go buy a property, you probably shouldn't, unless there's some exogenous reason, like something's changed in your life, there's been a significant market shift, one of those things where it's like, okay, something changed that we didn't know before or that happened in your life before, you should consider holding for longer than 12 months for financial and economic stability reasons. Cool. Should we go to the next one, Sean?
We're down, Sean.
We're down. All right. So in the next section, we've got, has the property experienced significant growth with 30% plus? Now, I'm not sure how we're going to explain the 30% plus, Goose. I don't know if you have some opinions on that.
Look, I think it's a heuristic, not a rule, is how I think about it. So when you're thinking about selling a property, and remembering that there's different ways to take profits, So if a property has gone up by 10% or 15% or something like that, you actually might find that a better way, a more cost-effective way to take profits is to refinance equity out of it as long as you can. But once you start factoring in things like selling costs and CGT and all of this kind of stuff, 30% is not a hard rule, right? But it's a guide. What if your property's gone up by 20%? All right, maybe take a look at it, run the numbers. And we've got some in the Strategic Sellers Toolkit. There is some spreadsheets in there to help you run the numbers and work out whether or not it's going to be profitable to sell. So that's a heuristic, not a rule. But in a general kind of context, you're going to have, a few percent in sales agent fees, then you're going to have conveyancing costs, then you're going to have CGT costs. Then what you actually need to also be thinking about is not just, am I making $1 of profit, but is this actually beating my hurdle rate? So we discussed hurdle rates in a previous episode as well. Maybe, Gabby, we want to link to that as well, how to win in investing. So setting and beating your hurdle rate. So understanding what your hurdle rate is really, really, really important, because sometimes you might actually, and this kind of is going to go into a point in a moment. In fact, the next point, are there drivers, metrics indicating the suburbs progressed a long way through its cycle? If it hasn't, and if you can see that there's still opportunity in that market move on a go-forward basis, you actually might be better off holding and waiting to beat your hurdle rate. So one of our clients sold a property the other day. They made 100% fully net after all costs and expenses and all positive and negative cash flows and everything over the entire holding period, inclusive of all costs and expenses. They made 100% return on their initial capital, right? Now, their response to that was, woohoo, I just beat Warren Buffett. The compound annual growth rate to achieve 100% return in 3 years is 27.9% compound annual growth rate on the capital, on all capital invested. That's a pretty good return, right? That's a pretty awesome return. And so thinking that through, thinking about, okay, not just like, where is my break-even point, but actually, is this going to beat my hurdle rate? So that's sort of where the 30% comes in. But again, that's going to be a very individualized situation. Maybe, and this kind of, as we progress through this, there are going to be other factors that you may consider selling it, even if it hasn't grown by 30%. But this is, again, a step-by-step process to go through and start to assess these points. Cool. So I'll go on to the next one, Sean, if you want.
Go for it.
Okay, so has it grown? Has the property experienced significant growth? So, by the way, all the white lines, that's a yes, and all the red lines is a no, right? Just to make sure we've got the right framework here. So has the property experienced 30% more growth? Yes. Let's assume it's going yes. Then are there drivers and metrics indicating the suburb has progressed a long way through its cycle? Yes. Okay, great. Then progress to the next step. Now, going back to point number 2. Sorry, Gabby, just scroll back up a little bit. Going back to point number 2. Has the property experienced significant growth? Let's say yes. Oh, no, sorry. Let's say no, it hasn't experienced significant growth. Then the question number 4 is, are there markets better positioned within their cycle that would re-accelerate your property portfolio over the medium term? Now, this is both 3 and 4 point to a single thing that you need to do: market analysis. You need to assess where you are in the current market, and you need to assess whether that is still the best opportunity, right? Because you might look at the market and you might say, actually, it has progressed a long way through its cycle, but in fact, you get to point 4 and maybe there is no better place for you to reposition your capital, in which case you may not consider selling. So understanding both 3 and 4, they're necessary and relevant points. And we're actually going to go through some metrics for you to look at in a moment to be able to assess where kind of market position, particularly where it's at in its cycle. But understanding to assess that and think about, okay, should I stay in this market or is there a better place for my capital to go is a very critical part of this step. And again, you may have a property that hasn't experienced significant growth, but then you might also look at the prospects and say, okay, it doesn't actually look like this is going to continue to grow. It might just be flat. I might have just bought the wrong property, wrong place, wrong time. And in fact, maybe I'm better to just sell this, even if it's only gone up by 5% or 10%. I might actually still be better off repositioning this capital in a different market and not succumbing to sunk cost bias. Sean, you got anything to add?
No, I think that's absolutely bang on. The only thing I'd sort of add is that, yeah, we're going to go through another decision-making framework to sort of enable people to make that market analysis themselves.
Cool. Jason, Callum, you guys got anything you want to add on this?
Nothing.
No,
Cool. Let's keep going then. So let's say you get to step 3. One sec. So scroll back up a little bit. Let's say you get to step 3. Are there drivers and metrics indicating the suburb has progressed a long way through its cycle? If the answer is no, then you would ask yourself, you'd go to step 5 and you would ask yourself, does continuing to hold this property stop your portfolio from continuing to progress? Such an interesting question. Does continuing to hold this property stop your portfolio from continuing to progress? If yes, right, then you would move back over to the consider selling side. If no, then you might not consider selling. Okay. And so this is where the market analysis to work out, are there drivers and metrics indicating the suburbs progress through a long way through its cycle? No. Does continuing to hold this property stop your portfolio from continuing to progress? No. Knowing what you know today, let's jump to 7 and let's just follow the no chain. No. Okay. Knowing what you know today, would you buy it again at its current value? Now, this is such an interesting question to get to at the end. So if we can just kind of scroll back up and just walk through that logic chain again, because it's a really, really important one. Let's just go through all the way through to the no. Just go all the way back up at the top. Have you owned the property for 12 months or longer? Let's just assume yes for the point of this. Has the property experienced significant growth? No. Okay. Let's go to number 4. Are there markets better positioned within their cycle that would help you to re-accelerate your portfolio over the medium term? No. Okay. Let's go down to number 7. Knowing what you know today, would you buy it again at its current value? Such a good question, because you may see something in that property that other people can't see. If the answer is yes, consider holding. Not hold, consider holding. All of this requires you to do some intellectual thought, okay, and really think about this. And if the answer is no, maybe you're just sitting there and saying, you know what, I bought a dud. It's time to go. I actually spoke to someone the other day. They've got 9 properties. One of the properties they bought has ostensibly grown pretty well, but they've actually incurred a ton of expenses. So they bought the property. It was a great property, right place, right time, plenty of market growth, but they've had to replace the roof. They discovered there was all these problems. A tree fell down, like all this stuff, right? And so once they actually calculate all of the expenses they've put into the property and then calculate the selling costs, they're basically at a break even, because they had to put so much money into the property, which, by the way, sometimes happens. That's real estate investing. Sorry. Right? Now, the question he was asking me was like, what do I do? Do I just, I think the market's at its peak. I don't think that this market is going to grow further. But if I sell this property, I'm basically at break even or maybe like a $10,000 loss. What should I do? And I asked him that, I walked him through this framework. And then I asked him that final question. I said, knowing what you know today, would you buy it again at its current value? And he said, I'm getting rid of it. Simple. Straight away, he was like, I'm getting rid of it. Because he wouldn't buy it again at the same value. So he's going to take that capital and put it somewhere else. So let's go back up to the top of the framework and walk through this again using the kind of like the yes context. Have you owned a property for 12 months or longer? Let's assume yes. Has the property experienced significant growth? Yes. Are there indicators and metrics are there drivers and metrics indicating the suburb has progressed a long way through its cycle? Yes. Are there markets better positioned within their cycle that would re-accelerate your portfolio over the medium term? I.e., are you a long way into a growth cycle and maybe you can reallocate your capital somewhere where the growth cycle hasn't yet started? Yes. If you sell this property, will you be able to actively reallocate the capital back into another market? I.e., do you have the borrowing capacity to purchase again? Yes. Great. Consider selling and reallocating. Consider. None of this is a hard and fast, like you must go do X. If you tick yes to these, then you must go sell. There's a framework for you to think about it. And you'll note that there are different pathways you can take. Because if you get to 6 and if you sell this property, will you be able to actively reallocate this capital back into another market? If the answer is no, then you may actually not want to consider selling. Now, there's a great example of a couple of our clients who were in this situation. They bought 5 properties with Dashdot, I think it was, in their early 20s or in their mid 20s, basically achieved like we'll call it financial freedom light. Like they have the option to kind of like work part-time and just they're not even 30 and they've got that optionality they're not like fully retired.
Financially flexible.
Yeah, we'll call them financially flexible. But part of the issue with that is because they basically stopped work for like a year, went traveling, and they're only kind of working sort of part-time, and they don't really have a solid income because they've achieved such a great financial position. They're actually not really able to borrow. And so we said to them, hey, let's take a look at your properties. You may want to consider selling some of these. And we walked through this framework and it was like, well, there's no point selling them because they actually can't reallocate the capital because they can't get any borrowing based on their circumstances. They don't have like stable employment and stuff like that. So in their scenario, despite where they were in the market cycle, the answer was, you know what? we're just going to hold it. We're just going to hold it through, because actually selling would not have given them, like they would have gotten the capital, they wouldn't have been able to use it. So it's really important to think through this framework from that lens as well. Jason, you got something to add?
I was going to say, yeah, with that 0.5, looking at it in the context of your portfolio constraints is super important, and making sure if you actually go ahead with the selling decision that it's actually going to get to the outcome that you want. Because the last thing that you want is exactly what you said, where you've sold a property potentially and you're not able to re-enter the market, and now there's an opportunity cost because you've lost that asset base. So definitely a really important consideration for sure.
Yeah, I think that is really important to sort of touch on, because there's three like simplifying it down, there's three considerations within this chart. There's the property level, suburb level, and the portfolio level. And it's very interesting. A lot of people, it's a bit counterintuitive, but if you follow that no chain that you were just following there, Goose, there may be a case where you have a property that hasn't grown. The suburb may not look like it is going to grow. However, it may still be a good idea to sell that property if it is completely stopping you from going and progressing and re-accelerating your portfolio to start growing again. So there's multiple layers to the consideration. It's very easy to sort of be sucked into, oh, the suburb doesn't look any good, get rid of it. But it's really important to sort of work through, is that going to get you the outcome or solve the constraint that you currently have to be able to keep moving and keep accelerating your portfolio?
100%. Awesome. Gabby, you got anything else you want to add on this? Callum, you got anything you want to add?
No, I think you've absolutely nailed it.
Awesome. So for those of you playing at home, or for those of you watching this is available in the Strategic Sellers Toolkit that you're going to be given, or you've got access to. And this can be the framework with which you can then start to get to a point, okay, should I consider selling or should I consider holding? This should prompt your thinking process to help you work through those steps. So should we then move on to the market stuff? Because let's say that you're like, all right, how would I know? How would I look at this from a market perspective? Should we walk through some of those? And Sean, maybe you want to lead on this. How would people know? But by the way, let me just quickly grab the mic back. So if you want to do a suburb level analysis, you can go to propertypathfinder.io. You can sign up to Property Pathfinder, and you can search almost any suburb. There are some suburbs that aren't in Property Pathfinder, and that's because there's not enough data on those suburbs, or there's some data integrity issues around those suburbs. But almost any suburb in Australia, you can find on Property Pathfinder. You can go and have a look at the data. The exact same kinds of data that we use internally at Dashdot is available to you for free. So you can go do your own suburb analysis to understand how to interpret things. And based on that, Sean's going to now walk us through some of the market. We might want to go to the slides, Gabby, that have got the, those the screenshots that I really love.
Yeah.
Yep. I will in a sec.
Able to answer questions 2, 3, 4. With this information and with Property Pathfinder.
Yeah. I think that was interesting to point out. Like these 2, 3, 4 are location related, and then 5 and 6 are more portfolio and finance related.
Two's property related, because you can actually have a property that's gone up in value disproportionately to the suburb or something like that.
Separate.
So it's really has the asset specifically, not just has the suburb gone up. But yeah, certainly points 3 and 4 can be solved through doing suburb level analysis.
Yep. Okay, so actually, how do we want to do this? Scorecard
really
first.
And then we can go through, and then we can go through all the sort of
I forgot about the scorecard.
What we're looking at on the scorecard.
All right.
In Toolkit.
Ta-da!
Forgot about the scorecard. Awesome scorecard.
We could do the spreadsheet too, but this is the PDF one.
Yeah. Cool. So I won't go through all of these metrics. We'll show you some images in a minute to sort of show you what we're thinking about, but really quickly sort of running through it. This is the same idea. It's a way for you to work through a suburb where you own a property and come to a recommendation, or come to at least an understanding of just some of the reasons you may believe that market may be slowing down, maybe at a good point in the cycle, and sort of arrive at those decisions for question, I think it was 3 and 4 in the previous slide. So we've got, has the suburb experienced a certain amount of growth? DSR trend lines, I will explain when we get to the visuals. I promise I will do that slow. So I got a couple on those.
Hang on a second. Slow down a little bit, Sean, because you just said DSR trend lines. So the first one is, has the suburb experienced 50% growth, 50% or more growth over 3 years? Now, 50% again is a heuristic, right? So it's designed for you to have a framework. Now, again, you will explain the DSR, what a DSR trend line is in a moment. But the second point here is the 2-year DSR trend line smaller than the 3-year?
Yep.
Is the 3-year trend line greater than the 2-year trend line, basically? Yep. Cool.
Yeah, 100%. Yeah, so moving down from there, then we have, is the 2-year DSR trend line neutral or even negative, which again, we'll explain in a second. Is the 3-month median time on market higher than the 12-month? Is the volume of rental listings experiencing a recent downward trend? And does the REMI price forecast model show less than 8% growth over the last 15 months? Now, the reason we have a scorecard with this is you'll see the yeses will have a certain point score. That's because to make these decisions, some of these metrics have different weighting to others. So it may be a stronger indication, let's say the top one, if the suburb has had over 50% growth in 3 years, that's maybe a stronger indication that's moved a long way through its cycle than, let's say, the rental listings or something that we've scored 1 point. So you'd go through, you'd mark these points out using Property Pathfinder, and then it would give you a score at the bottom, which right down the bottom, you can see we have 6 or greater, consider selling, and 5 or less, consider holding.
Nice.
Beautiful.
Cool.
Ready?
We're
I'm
ready.
Ready.
Slow me down if I get excited on DSR trend lines.
All right.
All right. Well, the first one's very simple. So this is just a screenshot of a suburb median sales price growth and median weekly asking rent we have in there. But you can see the past growth 3 years. This is a suburb that our clients have purchased in. You can see it's 80%. So the reason we did 50% or higher is it is a generalization across a lot of statistically relevant suburbs as to what percentage of growth may constitute a cycle. Now, again, that varies in different areas. How much will a cycle be? It will even change from cycle to cycle within area, but as a general heuristic, past 50% growth in 3 years means that, well, it's a good thing for you because that suburb's obviously enjoyed a lot of growth and it's a long way through its cycle. So that's the reason we'd assess that.
Awesome.
All right, DSR trend lines. Let's do it. So I think I've explained this a few times on podcasts, but you can see a little gray band down the bottom of this screenshot. So what we did is we ran correlation analysis with the way that we measure demand and supply. We back tested that over about 20 years in every statistically relevant suburb in Australia. What we found was an over 90% correlation with that value. So the green line, if that was above the gray band that we call the neutral band, it had a 90% correlation with prices going up. If it was in that band, prices were likely to stagnate. If it was below that band, prices were likely to drop. So this is a really powerful tool in monitoring or forward forecasting price movements in suburbs. So what you can see in this example here is we're not just talking about the value like I did there, we're talking about the trend. So the trend line is the black line that's running through the middle. So what you can see here is this is a 3-year trend line that is fairly well flat. So you can see the DSR, so the actual value has gone up since about October 2020. It's gone all the way to its peak. It's starting to come down. However, it's still above the neutral band. So it's really, really important. We're looking at trend lines here, not the value. If you look at the value alone, it is likely that this suburb will continue to have some price growth, but you can see through the trend that that growth may be starting to slow. So you can see Yep. No,
I was going to say, I want to labor on this point a little bit as well, because people can misinterpret what this means. So the value, the DSR value is less important than where it is in relationship to the neutral band, right? So just because it's higher or lower, or just because it's higher than the band, or it's going up at a fast rate, doesn't necessarily, like, if we look at the peak of that DSR line, and then we go, okay, well, it's been going down since July 2023. I promise you that the prices in that suburb have not been going down since 2023.
No.
Right? Because we're still above the neutral band. And so whilst this does give us a sense of how much demand there is in the market, the correlation is not with how high does it go versus that means that that's an indication of prices. It's actually, there's a correlation with it being above the band equals prices go up, and maybe at different speeds and different rates. And if it's in the band, its prices are broadly flat. And if it's below the band, prices broadly go down. And so to your point there, Sean, it's really, and I think it's very worth laboring on about, is yes, that is declining, but it is still above the band. So prices are most likely still continuing to rise, albeit perhaps at maybe a slower rate, but still growing nonetheless. And that's an important consideration.
Hey, Sean, just one point maybe for some of our listeners here. Do you want to explain just in layman terms what DSR actually is?
Yeah, so it's a demand to supply ratio. So we have a specific way that we measure demand and supply at Dashdot, which is a little bit of secret sauce, but it was obviously used in that testing back when we ran correlation analysis. They measured demand in a lot of ways. So this is our data and tech team measured supply in a lot of different ways, and we found the one that was that had the highest correlation, with the median sales price movement. So what this is it's how much demand there is in relation to the supply in that suburb as a ratio.
So you mean how many people are looking to buy versus the available dwellings? Is that in basic terms?
Quite simply, if you were to boil it down, how many people want to buy in that suburb versus how many options do they have to purchase? So you can see when it's very, very high, what that represents is chaos. Is that there may be 15 people turning up to open homes, multiple offers on every home. There's a lot of demand in the suburb, and there's just not enough listings to support that demand.
Yeah, there's a little bit more sizzle than that in the actual metrics, but yeah, that's the fundamental. Yeah. That's the fundamental basis. Is like, like how many people want to buy versus how many properties are available. So, yeah,
100%. So going back to the sort of trend lines, because again, I think it's really important that as Goose said, that the value here is it's not like a median sales price graph. That going down is not necessarily an indication of price going down. Quite often what we'll see in median sales price graphs is not a similar trend, but following the trends of a DSR trend line, but later on or time delayed. So even though there's been a big peak here in whenever it was, July 2023, and the DSR being this high, you can nearly guarantee it would still be very hot in this market, very hot. But as Goose said, it may be still growing, but the growth rate is slowing. So I think that's why it's really important to watch trend lines. So going back to the scorecard, the question was, is the 2-year DSR trend line less than the 3-year DSR trend line? So you can see here, the 3-year is about flat. So if we call that 0-ish, I don't know if my eyes are good at leveling things, but we can call that 0 in this graph on the 3 years. And then if you go on to the next slide, I have the 2-year trend line for the exact same graph. So you can see that's just clipping the trend line over a shorter time period. And you can see that is trending down. So that would be a negative value, -2, let's say for this example. So if this was your suburb and you're looking at it in Pathfinder, you would say, yes, the 2-year trend line is less than the 3-year trend line in this example. That also clears off the next question, which is the 2-year DSR trend line neutral or even negative? So what that means is it either flat or pointing downwards, which it is in this case? That one.
That one. Awesome.
So let's say we've got yes and yes. We're at 3 points for this suburb. And as a hint, I've probably knocked it out of the park with this suburb. We'll probably score maximum points. Awesome. All right, so we're going to the next one. We've got time on market. So this is another really important one. So the question was, is the 3-month median time on market higher than the 12 months? So I'll just explain time on market for people that I haven't explained it before is essentially how long a property, once listed, how long that property takes to sell. So essentially, how quick is the market moving? How long do listings take online before they sell? So we measure that in different time frames. So the green line that you can see here is the median time on market over 12 months. So all the sales in 12 months, how long do they take? What's the median? And then we have a shorter time horizon, which is the median time on market, 3 months. So that's obviously closer to the current state of the market, 3 months, because it's a smaller data set. So what you can see in this example is while the median time on market 12-month is still really, really low because it's had a long sustained period of market heat, you can see the 3 months has quite aggressively jumped up there. So what that's indicating is that the most recent listings have been taking longer to sell than the majority of the listings that have sold over the last 12 months, which would indicate a softening in the market. All right, so tick that one. So what are we on? We're on 2 points, 3 points, 4, 5 points. We've got 6 points already. All right. So volume of rental listings. So this is an interesting one. Is the volume of rental listings experiencing a recent downward trend? All right. So if we go next slide, please, Gabby. All right. So what we've got here, now this is more relevant to properties that were bought in affordable areas that were investment related, which is a lot of Dashdot all Dashdot properties that we buy. So what you can see here is a large spike in the volume of rental listings and then a downwards trend of that volume of rental listings. Why this is important, and I could probably eat up 25 minutes talking about this, is that the prevalence of geographically remote investment in Australia has increased dramatically. What that means is that a lot more people are investing throughout the country. Like Goose mentioned very early in the podcast, it's no longer you have to invest in your own backyard. They're investing wherever the best investment opportunities are. What that will cause is when a lot of those people jump into the same area, what it will cause is a large increase in all sorts of metrics that we can measure. The volume of investment loans written there, how many rental listings have popped up. So you can see in this example, what we're trying to illustrate is over that sort of July period, there was an awful lot of investment properties settling and being launched for rent. Now that demand is obviously causing a lot of the median sales price movement, so a lot of growth in the area. So as you see that start to subside, it's a sort of early indication to understand that maybe some of that investment demand is starting to subside for various reasons. Maybe the price has grown so much, the yield's compressed, the value isn't quite there, or a number of other reasons, but you can start to see that that investment demand is dropping off. It no longer represents the same value as it did for investors before. So it's a good way to sort of get ahead of noticing that investment demand moving in or out of an area. Cool.
Nice.
All right. What are we at? We got a home run yet? No, we've got one more.
Well, I think this is a seller. I think this is a.
I've already rung the agent, Sean.
Secret hint. I chose a definite seller. All right. Does the Remy price forecast model show less than 8% growth over the next 15 months? So our forecasting model obviously is available on Property Pathfinder. Sort of gone over the description of that a few times, but I'll still go through it really quickly. So again, we ran correlation analysis across a plethora. I think there's over, is it 1.5 billion data points in the machine?
Oh, no, it's more than that. I think it's 2.8 or 4 or something like that.
It's a silly amount of data points that go into this machine.
Yeah. I can't remember. I think it might be 4 billion. Yeah.
Yeah, and essentially the data and tech team ran correlation analysis across about 450 indicators. Some of those indicators we developed ourselves, so they're proprietary to Dashdot. Found the 60-ish that correlated the most with median sales price
of which
growth.
about half are proproprietary to Dashdot. So it's about
half are proprietary.
Don't quote me on this, but I think it's like 64 indicators that make up the model, and I think it's like 30 something that are proprietary. That are proprietary to us that don't exist anymore. That we had to invent from scratch in order to be able to put them into the model.
Yeah, so we're not just talking sort of vacancy rates or stuff like that. There's sort of combinations or different things that we've invented ourselves. That all feeds into one big magical machine, which I'm not capable of explaining on a podcast. That would have to go to one of our data scientists, and that gives us the price and rent predictive model, which you're looking at here. So in this case, I haven't put the percentages on, but you can quite clearly see it's relatively neutral over the next 15 months, which again, the price and rent predictive model is amazing and incredibly accurate, but you don't want to base your entire decisions on just does the predictive model say up or say down. It's a part of the scorecard which you assess. So in this case, it's stating neutral. So that's another tick on the home run box of the scorecard.
Yeah, I think it's a really good point to emphasize, because the shortcut isn't just go and have a look at the predictive model and go, okay, well that says that's what's going to happen. This is, it's still a developing technology, and there's things that we're constantly doing to improve it. And when we make improvements to the model, sometimes the outcomes change. And so this should be designed to help inform your point of view, but it shouldn't be your point of view. It shouldn't be the thing that 100%. You look at and go, all right, well, that's what's going to happen. Looking at all these other things. And in fact, looking at the scorecard that you put together there, Sean, this has only got 1 point versus, for example, is the 2-year DSR trend line neutral or even negative? That's 2 points. And so that should give you a point of reference to go, okay, it's not the be all and end all. It helps to inform our decision. No one has an actual crystal ball, and we are always looking at ways to continue to improve our price and rent forecasting models, but they're not the holy grail. They're not an absolute crystal ball. We do back testing. We do all kinds of stuff. Huge, like stupidly high, success rates with the back testing. But still, on a go-forward basis, the future is still the future, and everything is theory until it is fact. And so, using these other points of reference as well is going to be very useful to help you make a better decision.
100%. No, that's really, really important because, the forecasting model, like you said, I'll put one point there. The forecasting model can't understand a lot of the other sort of metrics that it can't be fed. The forecasting model didn't know that COVID was going to hit us 2 years ago or things like that. There's a lot more assessment. Like in assessing our suburbs within Dashdot, it makes up, I'd say, 10 to 15% of the considerations when we're going really, really deep on a suburb to determine whether or not we should enter it. So it's really important not to just look at that and be like, it says 8%, but mine says 10%, so it's going to go up exactly 10% in the next 15 months. Need to hold on to it. You need to look at it holistically across all the sort of metrics that we've put in that scorecard.
Awesome.
Yep.
Nice.
Sean, I just want to say thanks for putting this together, actually, because I think it's super valuable, just a framework to help people to make these assessments. Because obviously, like, you spend all day, every day looking in the suburbs, and I think people might jump into Pathfinder and look at the charts and not quite be able to read them. And I think particularly if you're approaching this with the lens of like, I have this asset that I'm thinking about selling, like it might be causing a constraint in my portfolio, being able to have this open and jumping into Pathfinder and looking at those suburbs, because all of the charts, everything that Sean's gone through in here is in Property Pathfinder. I think most of them are in the key indicators tab.
Key indicators tab. Yep, that's where you'd find all of them, and the predictor model is just in the next tab to the right of that.
Yeah, awesome. Yeah. So we have that. This is a PDF. Obviously, it's in the Strategic Sellers Toolkit. There's also this spreadsheet version. So this is more interactive. So you can go through and kind of like set your answers. So if you have Property Pathfinder open and then you have this sheet open, you can go through and do the scoring yourself, and it'll spit out the score and your result. Again, this is all about consider selling or consider holding. It is not us immediately saying you should go and sell. It's just trying to give you some frameworks on how to think about this. Sean, anything else on locations? Because I'd love to get into more like strategic finance, how we can think about this.
Let's get into it. Let's hear from Callum.
Awesome.
This magical unlimited borrowing capacity he's promised us. So.
Yeah. So assuming that you've gone through the journey which Sean just demonstrated for us there, and you followed your flow chart, and you arrived at some position where you've realized perhaps you've got some constraints, the conversation on finance starts to become just as critical as any of those previous points, because the way that it's structured and the way that it's set up from the beginning and what constraints it's created for you, if I was to, cross-section, people that have success in investment with large-scale property portfolios versus just getting to a few properties, the number one thing that matters most is the way that your finance is structured. Now, the journey that a lot of property investors will go through is initially, they'll come to Dashdot and I think, property investing sounds good. I'll buy a property, and they buy a property. They buy it in their personal name and they do well. And then maybe the conversation after that is, this property investing stuff, this is pretty good actually. Maybe I'll buy the second property. And then before you know it, they've got in this position where they've realized they've got these constraints in their portfolio that don't allow them to proceed purely from a borrowing power perspective. And the primary reason they're in that position in the first place is because there's a lack of forward planning when you first start as a property investor in terms of how multiple property purchases will fit into that. So the whole selling exercise can often turn into an exercise of really getting strategic about how you need to structure your finance and almost hitting the reset button and starting to allocate your capital in the correct places, and also pairing that with debt in the correct places so you can continue forward. Now, Gavin, do you want to... Sorry, go on, Goose.
Can I just jump in on a point there? Because I think it's a really interesting. It's something that I'm thinking about quite a lot lately, because sort of what you were pointing out there is that almost inferring that the correct way to build a property portfolio is to make sure you've got all the right structures in place in the first instance, which is kind of true, but it's not absolutely true. And in fact, when we started talking about investing in trusts and doing all that kind of stuff, I don't know, 4 years ago, 5 years ago, whenever it was, like a lot of people really, the very first, we had a conversation with Stephen McClatchy on the podcast. That was really a big eye opener for me. And honestly, there wasn't really anyone talking about it before that episode. Then it started to become something that people talked about. Now, actually, I think the whole idea has actually grown arms and legs to the point where everyone just thinks that buying properties in trusts is some magical solution to infinite borrowing, and you should just do everything in trust. But at the moment, right, so whilst in principle I agree with you, because I, like you, have seen most successful property investors, they start by buying in their personal name. Then they build their portfolio, and then they go, oh my God, then they have to go sell the properties they bought in their personal name, reallocate and buy in trust. And so there is this kind of like, should they have bought the first property in their personal name or in a trust from the get-go? Because almost invariably what happens is we see successful investors have to go back and sell those earlier properties because they're in their personal name and it's stopping them moving forward. But what's interesting is when we think about the theory of constraints in a portfolio, we think about access to debt, access to capital, access to cash flow. At the moment, some of the biggest constraints that people have got is the cash flow side of things, particularly when they're just starting out. Like particularly when they're buying their first and second property and they've got to put in savings. They've like, what's their savings rate? Is that going to be enough to be able to support the property? And so there's a strong argument that in those cases that there actually may be more advantage to them doing it in their personal name so they can claim the negative gearing tax benefits so that can offset the negative cash flow and actually make it affordable for them to get in. And so I don't think I think it's an important, and this is more of a kind of like a philosophical point to make around this, not to kind of hijack anything that you're about to talk about, but it's interesting to consider all of those options. And it actually, for some people, even though the quote unquote best way to build a property portfolio is to have everything set up in the right structures from the get-go, in many cases there's still potentially the best path for the first couple of properties is actually just going to be to get people started to still buy in their personal name. So I think it's one of those things that needs to be considered. I don't think that, and I think that's actually the piece that's missing is people aren't considering it. Like they're not going, well, what would the right structure be for me right now? Now, back to your point, as you get deeper into your property portfolio, if you do start with buying in your personal name, almost certainly you'll get to a point where you have to go back and sell those properties you bought in your personal name anyway, right? So there'll be a point where you need to get rid of them in order to keep moving forward. But also that doesn't necessarily mean that starting in your personal name is the wrong place. Do you kind of agree broadly with what I said there?
Definitely, Goose. And I think the challenge with it is your goals as a property investor tend to be ever evolving. So even if you are strategic in the first place, it could be, okay, well, our initial goal is, we want to buy 2 properties, we want to sell one of them, pay out our home loan. And if that is your initial goal, then the whole narrative around trusts and so forth is probably not really part of what you're even considering in the first place. It's just how you navigate the strategy with ever evolving goals to make sure that you can continue to proceed. So as much as we do our best up front to try and establish, what are you actually looking to achieve with this and what strategy best aligns with that, which could be a few properties in personal name, that's where the difficulty comes in being able to have that granularity and being able to continue to work that as it evolves.
I was just going to say as well, Callum, I think the strategy side is so important, and it sometimes gets missed because people would look at finance as just like, hey, I bought a property, can you just help me get the loan? I think it's really important on the front end, especially when we look at some of the clients that have made these mistakes on their journey, is really going to the broker with what they're actually trying to achieve long term. And I see this as a responsibility for the broker more so to look at what the client's actually trying to achieve and helping them at least understand where they're going to get stuck, as opposed to being more of an order taker, getting that loan sorted in personal name without them really understanding the second and third order consequences. So more of an educational side, because at least when the client is going into it, they're going in with 2 eyes open and they're fully aware of the ramifications of their decision.
Yeah,
I did it. I did precisely that. It's just like, I could make money in property. Found this property, great deal. Just bought it, and it was in personal name, and I didn't think anything about it. See, the broker at the time didn't give me any sort of strategic advice, and that property is currently on the market because then as things evolve, you go and you buy a big PPR and you put other things in your personal name, and then it does get you stuck. So having that strategic piece from finance is as important as getting your property selection and your suburb selection right.
So I'll add one more piece to that before we let Callum continue on his section here. But just with that in mind, like strategically financing. So whilst that may or may not involve investing in a trust or a structure like that, it almost certainly involves having a clear finance strategy laid out. Someone who's thinking through not just how do I get the next loan or like how do I finance this property, but actually how might the financing of this property be set up so that I can buy subsequent properties, right? And so what the problem that I see is a lot of people shop on interest rates. They just go, well, Johnny Magoo down the road, he said I can get an interest rate like this. What they're failing to understand is, yeah, but Johnny Magoo's talking about cross-collateralizing your assets, or, actually, yeah, borrowing from that lender is going to stop you from borrowing it from a different lender in the future. And so getting this piece, all this stuff early on is really, really important. But we're not here to talk about all early stage financing strategy. So I'll let you continue.
Yeah, Gabby, do you want to bring up the impact in borrowing power slide there, and we'll start there.
Can do.
So what we're going to do with this one is we're going to skip point 1 for the time being, just because we've semi-covered off on it, but it's better covered off in the next point. And I'm really going to cover off on points 2, 3, and 4. So the reality of it is the majority of your success after you decide, that you're going to move on from a sale is going to come from the structuring. And I think the thing that often gets missed in the dialogue about this is particularly point number 3 around the cash flow of the particular asset. So a lot of people, they start to get in this position where they can become hyper-focused on the rental yield. And whilst that might put you in a better position if your constraint is physical cash flow, in real terms, it will help you out with that. But the challenge that you're going to find with the way that banks assess loan applications is minute differences in rental yield really don't make that much of a difference in your borrowing power, especially when you've got properties, that might have a crazy yield, even an 8% yielding property. Whilst in real terms, it's going to help you with your cash flow, that's not really going to make or break your investment strategy from a lending and borrowing power perspective. So that's the first point. And then if we start to move on to how you might actually do this in practice, apart from, how you might structure new purposes. Another strategy which you can find to be super powerful in terms of increasing your borrowing power and allowing you to move on to another purchase is using the sale proceeds to recycle some of your debt. So let's say, for example, you come out of the transaction, you might have $300,000 of liquid cash you've taken from the sale of a property. Now, you may be intending to use that $300,000 as the deposit on your next property or next properties. And imagine that you've got an owner-occupied debt. It can be really powerful in terms of increasing your borrowing power to use that $300,000 to pay down your home loan. And then at the same time, we also reborrow that $300,000 as an investment purpose loan. So what that first step does is it really starts to shift the balance from owner-occupied debt towards investment debt, which ultimately results in you having far greater borrowing power. And you haven't really done anything to change the total level of debt that you have in that case, apart from allocate it to the right spot to ensure that you can borrow more money from there.
Yeah. That's a debt recycling strategy, right?
Debt recycling strategy, correct. Yeah. And then the other challenge, which a lot of people get into as they've scaled out their portfolio, if we look at point 4 there, is through time, what tends to happen, especially if you've bought properties in personal name, or maybe, again, even it's your owner-occupied property, is that you continually take all these equity releases against those properties that you've previously owned, which you've used for your deposits. Now, if they've been structured correctly, the finance would be standalone. So you might have, 2 equity releases over here secured to your PPR, which you may have used for 2 investment properties over here through time. But what you're doing in that instance is you're continually loading yourself up with further personal name debt with those equity releases, which through time makes it more challenging for you to continue to scale your portfolio, which I'll cover off on the specifics of why that is there. But the sale of your asset is also an opportunity for you to redistribute some of that income to perhaps reduce some of those equity releases that you've taken in personal name and start to shift the balance of total debt that you have in personal name versus alternative structures like trusts, which obviously you have to seek advice on whether they're suitable for you, but it's pretty much unequivocal that you can borrow a lot more money if you buy properties in trusts. That there's not really any discussion about that. The discussion is only really about whether that's the right strategy for you to be taking from an accounting and legal perspective. Any questions from you guys on that before we move on to the next slide so we can talk specifically about structuring and trusts?
No, the only point that I was going to make was the point that I kind of made earlier around how. So we sort of talk about trusts and like being able to borrow more and all that kind of stuff. But it's my understanding that the trust needs to be in an operating profit for it to be effectively the entity holder of the debt. That's broadly correct.
Yes and no. So there's still a whole heap of flexibility benefits with it being in a trust, even if it is cash flow negative, which we'll cover off on the next slide. I've got something specific about it, but it's an important point to circle back to. I think a lot of people are perhaps mistaken on how borrowing power with trusts work and the effect that negative cash flow actually has on your borrowing power, even in that circumstance.
I think we should really dig into that. So if that's in the next slide, I think it'd be really, really important to dig into that, because as I say, what's happened since we very first did that episode with Stephen McClatchy is it's just become this thing where people are like, oh, just buy in trusts and you've got it's an infinite money glitch, which is not true specifically, or the trusts have to be cash flow positive, or do the trusts have to be in an operating profit? Operating profit is different from cash flow positive. So if we can kind of explode that apart, and I think you and I were talking the other day about how even if it's cash flow negative, how like that difference is in the personal. I'd love to dig into that so we can kind of clarify some of those points, because this I think is really going to be key in helping people understand. Because let me go to because I love talking about real stories. So I spoke to a guy the other day who's now become a Dashdot client, and he had X amount of dollars of borrowing capacity. And I showed him, hey, and X amount of capital and all of this kind of stuff. And I said, hey, so you're in a position to be able to go buy 2 properties. And he was like, okay, so I buy those 2 properties. That basically uses up all my available debt. You're talking about getting to like 5 properties. So like, how do I buy these other properties? And it's a really interesting, it's a really like consistent logic chain. So being able to kind of talk through, okay, how does this evolve? Like how do these kind of structures allow this kind of stuff to kind of move forward and evolve? I think it's really, really good to blow apart, because particularly when you've got people who've started their portfolio in their personal name, maybe they have found that edge, understanding the mechanics of how this does change, it's going to be critical. So if that's on the next slide, let's go there.
Yeah, please, Gabby.
Cool.
Okay, so what we're going to start with here, this is really ground level in terms of how is a bank assessing your borrowing power when you own properties in trusts versus when you happen to own them in personal name. So if we start with this hypothetical property here, you can see it's worth $600,000, average rental yield, 80% LVR, all those figures there are pretty vanilla. So what we want to consider in this circumstance is, let's imagine that you already own this particular property, right? So let's imagine that you happen to own that property in personal name, which is if we head off to the left there, this is the analysis that a bank is doing for your future borrowing power if you happen to own this particular property in your personal name already. So what you can see here is when the bank is doing this assessment, they're taking 20% off the rent that you receive, so it drops down to $24,000 per annum. Now, in this example here, the mortgage is on an interest-only term, 6.5%. So the bank is then going to take that mortgage over 25 years P&I, and they're going to add 3% to the interest rate. So that repayment in bank assessment land actually becomes more like $50,000 per annum. Now, they're going to give you a bit of an add back for the negative gearing. I've just assumed this at standard marginal tax rates. So what you basically end up with is, let's imagine you're going for another transaction. By bank calculations, this property in your personal name is actually cash flow negative $18,429 per annum. So that's the phenomenon that you see, where regardless of the cash flow of the properties that you have in personal name, even if you had 8% yielding resi properties in your personal name, unless they're at a super low level of debt, what happens is you still ultimately just get diminished returns on your borrowing power, and then eventually none, even if they are actually producing positive cash flow for you by the way that the banks assess it. So this is why the personal name route, if you're looking to scale, will ultimately end up with you running out of borrowing power, unless, like you mentioned before, Sean, you're someone whose income can continue to increase. That's probably a different situation. Now, if we instead think about that existing property that you own, that is owned in a trust, and imagining that you're going out there to proceed on another transaction with another bank in another trust, or even in your personal name, the assessment that the bank is doing of this property that you already own in the trust, literally all they're looking at is a profit and loss statement for that particular trust. They're not doing any assessment on any of the rental income, nothing of the sort. So what ends up happening is, by bank assessments, that trust that you've got out there with another lender, the actual cash flow that the bank's using in their borrowing power calculations is what the actual cash flow is. So in this case, it's actually negative $6,200 per month. Now, going back to your question before, Goose, which is always on people's minds, it's like, but what if the trust is negative cash flow? Like, isn't that bad? Doesn't that make the whole strategy fall apart? So what happens in this circumstance with most lenders is, when you're going to work out your borrowing power for some future transaction, all that lender is doing is taking $6,000 off your income and then working out your borrowing power, which still works out to be substantially better than if you had the property owned in personal name, even though there's no negative gearing benefits over here. So essentially, the belief that most people have that property that's negative cash flow in a trust equals I'm stuck even worse, it's actually not the reality. And the other part, which isn't factored into this, is all the flexibility that you get with this structure, where you can, through time, make this property be cash flow positive. It's like maybe right at this point in time, it's not, right? But if you've sold a property, you've got some capital to reallocate, maybe you decide to reduce the debt in this particular trust. Maybe you decide to put some of the cash in the offset account so the repayment reduces. Maybe you loan some of that money to the trust. You just have all of this flexibility, which experienced property investors through time, they realize you have to navigate through these challenges, but the flexibility that you get with the trust structure to allow yourself to position this property to either be cash flow positive at some stage in the future, or even if it's not, it's still making your borrowing power better. This is where it really starts to separate out those who want to get stuck at a couple of properties versus those that really want to be able to progress further. It's primarily down to the flexibility that you get over the right versus over to the left.
It's such an interesting point that you're making here, because most people think that it's binary. Either it's the debt is siloed, for lack of a better term, in the trust, or it's not. So either it's cash flow positive and therefore the debt is siloed in the trust, binary, yes, or it's not cash flow positive, therefore the debt is not siloed in the trust and you have 100% of the liability of that debt on your kind of like personal balance sheet. But what you're pointing out here is that that's not the case at all, that the debt is still within the trust. But if it's $6,000 negative cash flow and you earn $150,000 a year, the bank is going to say, okay, well, you earn $150,000 a year minus $6,000 because that has to go over to the trust. But other than that, the debt's still sitting over in the trust, not in your personal name. And so I think that's a really, really important distinction for people to understand, that it's not a binary on or off switch. Debt is siloed, debt is not siloed. It's just if there's a negative cash flow balance, they'll consider that you need to pay that into the trust as part of your personal borrowing when you think about borrowing for the next one. That actually makes that whole strategy even better, in my opinion.
Absolutely. Yeah. And and the other thing too is there's not consistency amongst lenders that it's uniformly treated like this, but the level of flexibility that you get, there's still a whole range of lenders where you can continue to transact on that basis. Yes, some lenders are going to go deeper into it and say, we want to include the debt, we want to reduce the rent. That does exist, but you just have so many more avenues even in that case. And then the other thing which we're seeing at the moment is there's a handful of lenders in the market now where they're not just making assumptions about trusts that you have, and they don't even care if they're cash flow positive. We call them free hit lenders. They're essentially saying if this debt belongs to a company and or a trust, and we don't have an interest in it, we actually don't even care about the profitability of it. So it's not to say that you want to rely on something like that, but this is something that evolves through time and has evolved through the last 5 years, that there has always been more flexibility and more ability to borrow money in trusts, even though the market does vacillate between different lenders offering this policy, that policy, the way they assess it. Universally, you get more flexibility and borrowing power regardless.
Yeah. And before we move on from this, I just want to go back to one of the points you were making, and a point that we've made earlier as well, is around the capital reallocation aspect. So as you're thinking about, like, as you have trusts and maybe they are cash flow negative or any of these kind of scenarios, selling down properties, reallocating that capital to maybe sit in an offset account in one of your trusts, bringing that into profitability, like all of these are things that you can do when you strategically sell and really think about resource allocation and capital allocation within your portfolio that allows you to navigate the lending capabilities, which is going to lending and cash flow capabilities in your portfolio to allow you to continue to move forward. Because it may not just be a borrowing capacity issue, it could be a savings rate issue that you've got, in which case perhaps you don't, maybe it's $6,000 negative cash flow. And let's say you've got 10 properties, right? And they're all $6,000 negative cash flow. That's $60,000 a year. What if you can't afford the $60,000 a year of negative cash flow? Well, reallocating equity after you've sold assets to reduce the debt on some of your properties can actually decrease the negative cash flow, which is then going to give you the flexibility and the capability to be able to support future purchases that are bought in the right structure and in the right ways. So understanding how to reallocate these things to create different outcomes and different effects is really, really important. And something I spoke about on the cash flow jiu-jitsu podcast that we did was even the concept of taking equity, illiquid equity, and turning it into liquid equity simply by refinancing out the equity out of one property and then putting it into an offset on the same property. You don't have any difference in the actual total debt amount that you hold. But what you've got is you've got equity that you can use like cash flow, i.e., that can actually support some of the expenses if you have a shortfall on a month, on the odd month or whatever. It's not a long-term strategy. It's something, but thinking about how you can start to transform the way capital lives inside your portfolio is really, really critical. And I actually had a conversation with someone the other day, and their biggest concern was they had plenty of borrowing capacity, and they had a PPR, a home, a principal place of residence, with a ton of equity in it, and they had tons of borrowing capacity, but they just didn't have a very high savings rate. And so their biggest concern getting into, like, they had enough of a savings rate that they could go and buy an investment property and they could support some negative cash flow and all that kind of stuff. But their concern was, what if something happens? What if the car breaks down? And what if 1 month we just don't have that on that occasion? Their ability to take the illiquid equity in their PPR, turn it into liquid equity in their PPR sitting in an offset, gives them that flexibility and that peace of mind to know, okay, I can go for it. And just in case, I've got a liquid capital backup and my equity starts to act like cash flow. And really thinking this kind of stuff through is how strategic portfolios get built, and then how you think about reallocating capital within your portfolio when you start to do things like strategic selling.
Definitely. And I think just going back to the initial point I made about, most property investors, when they start out investing, there's nowhere near this level of granularity in terms of how they're planning out their strategy. So the sales event really should be the opportunity for you to sit down with your mortgage broker and really get strategic and think several properties ahead. And the level of granularity you should be getting is, okay, well, based off of my end goal, that means we should be putting 2 properties in this trust here. The cash flow will end up roughly about this point in time. We can use X amount of capital to make sure this particular trust is profitable. We can use the leftover capital to put over here to make sure this trust is profitable. Use $100,000 for your rainy day fund. Like, those are all the sorts of important metrics that need to be built into a granular strategy after a sales event to make sure you can continue progressing forward with multiple transactions from there. And that's the sort of thing that if you had that level of granularity up front when you're building a portfolio, maybe you wouldn't have ended up in the same position of constraints that you have now. But that's just the way it goes with ever evolving goals.
Awesome.
100%.
All right. We do need to move on to how. Before we get there, actually, Jason, I'd love to hear your insights, because you obviously, it may not be obvious to everyone, it's obvious to us, but you head up kind of the portfolios function in Dashdot. So we have the portfolio strategists and then our portfolio review team as well. So you're seeing this pretty much every day, thinking through like portfolio strategy. Is there anything else kind of on what Callum's talked about that you wanted to share from your point of view?
Yeah, it's a really good point. And what we're doing as part of the portfolio review service that we're helping clients with is kind of bringing all of these things together. So we start by doing a strategic portfolio review, looking at all of our clients' properties, figuring out if there is a strategic opportunity to take profits. From there, what we're doing is actually linking in with Callum to understand the borrowing implications of the current situation that we're in now and the future situation that we want to get to, and looking at whether properties can be structured specifically from a finance perspective to allow clients to move forward. We've seen, I know Callum just mentioned clients buying in trusts, but even when you are looking at trust purchases, looking at how much debt you have in each trust can also make or break the portfolio as well. Like in my own journey, I purchased all my properties with Dashdot in trust, but I put 4 properties in one trust, which kind of suffocated the portfolio and restricted me from being able to take any profits out of that portfolio. So maybe that's something we can go into a little bit later, Callum, but having a look at if you are going to structure your portfolio, what's the most effective use of resources and how those portfolios need to be able to scale to move forward, and then combining the finance strategy with the portfolio growth plans and our portfolio strategy team to look at what does actually executing on this strategy achieve from a goals perspective. What does the total portfolio look like from a cash flow perspective as well, is becoming really important. To echo what Goose said, a lot of the scenarios that we're working through with clients at the moment is setting aside some of those sale proceeds to have as buffers, whether it's to manage negative cash flow, whether it's to create more safety and security in the portfolio, whether it's to use for other ventures. So really looking at, like what Callum said, using the sale opportunity as an opportunity to review your entire portfolio, the way you've got everything structured, your long-term goals, and resetting things to set you on the right path, if it makes sense, is really important, not just looking at it in isolation. So I think the way we've looked at this podcast and the topics that we've discussed, it's really important to kind of bring them together so you're not doing anything in a silo. But we can share some of the recent portfolio reviews and case studies as well if you want to go through some of those.
We have 15 minutes left, so
I think we might not have time. What I think we might need to do, because we all know that there's so much stuff we haven't spoken about. So what we may want to do is we may want to do a follow up to this, or break it apart and kind of cover off a few things. You know, I think there's a bunch of stuff that we love to cover that we haven't covered. I think if we, in our last 15 minutes, we should really get into, okay, so let's say that you have gone through the first process, which was working out, okay, why should I consider selling? Okay, now, all right, I want to consider it. How would I know when it's time to sell? You've gone through the decision-making frameworks. You've gone through the Suburb assessment frameworks, had a look at the market metrics. Now you need to start thinking about, how do you sell, right? What would you actually do? If you've decided, you're at a point now where it's like, okay, it's time to go. Let's do this. I've decided I want to commit to it. Now, obviously, well, not obviously. So we have just launched a service called Sell Assist, but it is still very low capacity because we're still building out that team. And so what I think would be useful is if we can give people some guides, frameworks, tools, instructions on how to go do it themselves. So let's say you're in a position where you're like, all right, it's time to go. And how can they take action on it themselves? I think if we could knock that off in the next 15 minutes, I think we'd do well.
Sounds great. Do we want to use the checklist then, Gabby? Can we share the checklist?
Well, we happened to have prepared this earlier. Give me 1 second. And my computer has decided that now is the perfect time to just glitch out on me. So in case I'm a bit choppy.
You did forewarn us.
Okay.
Do you want me to share the
No, I think we're good. Yep. All right, Jace, do you want to run through? I don't think we go through everything, but just like the main things that we think are really important for people to think about.
100%. So as we've gone through the sales support service and building this out for our clients, there's been quite a few steps that we've had to work through. So we've tried to create this checklist to give everyone a general overview of the things to consider when you're selling, some of the things that we've uncovered as really strategic opportunities to assess before you make that decision, and then kind of guiding you through the entire process. So in line with that, the first thing that we've got on the due diligence side of things is getting a sales appraisal on your property. We usually recommend getting multiple sales appraisals here, similar to how we assess properties when we're looking to get equity out of them as well. We want to make sure we're getting the highest sale price possible. So what we like to do is compare and get at least 2 sales appraisals. What we're doing for our clients on the sales assist side is working with very trusted agents that we've worked with on the buy side, and we know they're able to achieve a really good result. So really important to get that and then run the numbers. So looking at, we've got some more links in there as well, but looking at if you sell the property down, what does that look like from a net cash flow perspective, considering things like capital gains, tax, agents, commissions, any marketing fees. From there, we've got preparing the cost-based worksheet for your accountant. So when you usually sell a property, there are entry and exit costs associated with that, and there is some tax benefits gained when you sell the property that you can claim back. Things like stamp duty. If you've paid a buyer's agent, there's buyer's agent fees in there. So it's really important to make sure you're keeping track of those costs, especially when you're purchasing a property. It's good to have a folder there, just because it can make quite a significant difference in the total tax that you pay. Once you've got that cost-based worksheet populated to the best of your understanding, have a chat with your accountant to work out whether that has been populated correctly and what that CGT tax situation would look like if you sell.
I just want to add quickly on the cost-based worksheet, because you flagged this a little while ago, but in terms of any depreciation that people have claimed so far, do you want to just touch on that quickly? Because I think this is really interesting.
Yeah, this is something that is quite interesting, and we've picked up in the last 12 months. If you are claiming depreciation on your property, those expenses do get added back to the sale price and do get added back when you actually sell the property. So it does get added into the sales cost. So in the cost-based worksheet, we've actually added a section in there where you can put in the depreciation that you've claimed year on year. And you can add that back in when your accountant's working out whether you should sell a property or not. It's a really important consideration because we do encourage all of our clients to get depreciation schedule estimates on their properties when they do purchase them, just to make sure they're maximizing their tax position there, but also noting that that cost will get added back when you sell the property, but it is added back at your marginal tax rate. So you're still getting a substantial benefit from the depreciation, but it's worth consideration for sure. Having a chat with your accountant about it further if you had any specific questions for your scenario.
Yeah, because how I understand it works, it's like, let's say you sell the property for 600 grand, and let's say you've claimed 20 grand of depreciation over the lifetime that you've held the property. That 20 grand gets added to the 620, so you end up like the value is 620, and then you get taxed on the gain that you've made on that. Is that correct?
Yeah, that's right. That's right. And if you've held the property for 12 months, like we've put in that framework as well, you will get a further 50% discount on that as well.
Yep.
Cool. Then we've got the listing process. So engaging the sales agent that you've decided to go ahead with. It's really important to also engage a conveyancer during the start of this process as well. Sometimes we can get to a stage where we engage a conveyancer when we have contracts, but it's really good to engage a conveyancer earlier in the process for a couple of reasons. Like in some states, specifically Victoria and New South Wales, the conveyancer is actually responsible for preparing the contract of sale. In Victoria, it's a Section 32, which is the vendor statement. So it's really important to consider having a conveyancer on board earlier just to review the contract, get that all sorted, make sure there's any special conditions you need to include just to protect your rights under that, and then listing the property for sale. Once you've done that, the sales agent will market the property, look at potential offers that have come through, acceptable terms, and you can review that alongside the agent. With our clients, we're actively reviewing those and actually helping in some of the negotiations as well. We've already had some pretty quick wins. We've been able to create $20,000 to $30,000 worth of counter offers from us jumping in and generating a higher sale price for our clients, which has been really cool. From there, you decide which offer you want to accept with the agent's guidance or with us if you're using the sales assist service, and go ahead with that. There'll be contract execution, which traditionally the sales agents will sort out in most states, but in some states, particularly New South Wales and Victoria, the conveyancers will jump in to be able to do that. Once you get a contract once you get your property under contract, the conveyancer will jump in with a few things. So one is if you are selling the property and you have a mortgage attached to it, they will ask you to complete a discharge form just to be able to make sure that loan is removed at settlement. This can actually take quite a bit of time, and I'm sure Callum jump in if I've said anything rogue here, but traditionally it's about 25 to 30 days. Most banks will take to discharge the loan. So it's really important to start that process earlier, because if you do it later, it can potentially delay your settlement. Working with the buyer to complete their conditions. So traditionally most contracts will have a finance, building a pest clause. So working through that, and any issues that come up, the agent will obviously be able to help support you on that side as well. Once those conditions are satisfied, the contract will go unconditional. We'll have a booked settlement date. This is the stage that we usually look at reallocating capital into another investment property, because we've already confirmed what the end sale price is going to be. We've confirmed the sale is actually going to go ahead. The accountant can use this information to finalize any capital gains tax payable as well. So we'll have a really clear understanding of how you're able to move forward and how much resources you're going to have to be able to put towards the next property or whatever it is you're looking to do. Once that's done, the property will settle, which is just where the money hits your bank account. I think this has been a pretty big shift for a lot of our clients actually going through the process, because you can obviously see the numbers and see how much growth you've made, but actually realizing that and having it land in your bank account, I know even for me as well, was a pretty big fundamental shift there. Once the settlement goes through, you'll get a settlement statement. Again, super important to make sure you have this in a folder somewhere, because your accountant will be able to use it to organize the total CGT payable when they lodge your tax return. And then with the capital gains tax, making sure that's set aside for your next tax return, because it won't be collected at settlement. So using the numbers that your accountant's provided, just making sure you have those funds available somewhere, because sometimes if you don't do that, you will end up with a pretty hectic bill from the ATO when you go to lodge your return. So making sure you have that. An offset account is what our accountants are advising at the moment, just so you can get some benefit there until you actually do have to pay those funds when you lodge your returns.
Nice. Awesome. Yeah, obviously, look, there's a lot that goes into this process. I think obviously there's more that goes into buying a property, but also all of these steps, there's also a lot of paperwork, transparently, which is why we actually decided to start offering this service, because transparently, Goose and I went through the process of selling a property. We are very busy people, and it was an absolute nightmare, like headache of just trying to sell. Now, obviously, if it's a decision that you want to do, it shouldn't be something to put you off selling, because it's just kind of what has to happen. But we do now offer this for a small amount of clients at a time. It is clients only, to do the sale as a service, to kind of guide you through this whole process as well. We have 5 minutes left. I don't think we're actually going to have time for Q&A. I'm sorry if you're here live and you have some questions. If you do have a question that you want us to answer, what I'd recommend actually, there is the link in the YouTube description to submit a question. And Goose and I can review those over the next couple of days and get back to you there if we didn't get a chance to answer live. Or if you're watching this at any point and you have any other questions that you want to shoot those through, there is a link in the YouTube description. One thing I want to touch on really quickly before we finish up, because I think it's important, is just people are probably thinking about reallocation strategy. And so a lot of this comes down to, like, in that flow chart, we're thinking through making sure that you have the ability to reallocate into something else. Obviously, in most cases, if you don't have the ability to move those funds, like you don't have the borrowing capacity to buy another property, then you should factor that into your decision. But what kind of just high level opportunities are we seeing in the market right now, so that people understand that there are opportunities for them to reallocate? Because I think particularly if clients have bought properties maybe, I don't know, 3-4 years ago at a certain price point, like what price points are we seeing? What are we seeing on the ground in terms of opportunities that they could reinvest into?
Yeah, I think it's an interesting question, because I remember when we very first started, we were buying properties in the kind of like low 200s and stuff like that. And I think the cheapest property we ever bought was 170,000, if I remember correctly, or something like that. Which, by the way, performed exceptionally well. Those individuals did very well out of that. But just taking one step back, the reason that one of the reasons that kind of the finance section came before the selling section as we went through this episode, is because you need to get the finance section, you need to get the finance sorted first before you consider selling. You need to know, can I reallocate capital before you sell? There's no point selling and then going, all right, I've sold. Hey, Callum, can you get me some money? And it's like, maybe you can't get it, right? So you need to walk through that first. Before that is part of this, the selling decision-making process, is like, okay, I may want to sell, but I need to work out, can I actually use that capital? Sean, do you kind of want to talk about where some of the opportunities are at in the market? Because we're still buying in the sort of, what's the kind of like low end and high end of where we're buying, and what are the kind of market dynamics look like, yields, stuff like that? What's the kind of general 10,000 foot view?
Look, I think something to sort of reiterate that we've said a lot of times is that there's no Australian real estate market. So there will always be, at any point in time, different markets that are at different places in the cycle, hence why this is a really effective strategy. So like what Gabby said, if you did buy something, let's say in Western Australia 2 or 3 years ago or something, you've had a phenomenal amount of growth. There is always different markets at different points in the cycle, which is why this works really well. But in terms of price ranges and yields and things like that, look, we still purchase on average anywhere from, 300, sometimes a very touch below, all the way up to 800 and beyond, and larger purchases in different asset types. But the general bulk of opportunity is still sort of somewhere around the 500, 600, 650 sort of mark, is a lot of the properties that we buy. But yeah, I guess the only sort of thing to reaffirm is that some of the opportunities that we have identified right now, from a data perspective, look precisely like what a lot of our big wins look like 2 or 3 years ago. Hence this discussion. We obviously selected those suburbs for a reason back then. They've performed exceptionally well. Some of the suburbs have had 100, 120% growth in 3 to 5 years. So they've done exceptionally well, which is a really good thing to be having this conversation, not a bad thing to be considering selling. So it means you've done really well out of the property. And then now we're looking at new areas and new suburbs, which have those same indicators that we identified 2-3 years ago, which is why we're so excited about this sort of opportunity to then, for people that do want to be slightly more aggressive, to take all those profits and then reposition to ride the wave again, maybe at a larger scale. Maybe they get 5 in this wave when they only got 2 last time. And it's a really good way for people to, very early on in their journey, to sort of jump 4 or 5 steps up the line to really get to a level that's quite impressive. So in terms of opportunities, there's some really exciting stuff that we're looking at currently.
And I might just add to this as well that, sometimes you're not going to time the market perfectly, by the way. Like sometimes you may be in a market and maybe you move just past its crest a little bit or something like that. And it's like, okay, maybe the demand has softened in a location and maybe you missed the optimal time to sell. Maybe that's still okay, by the way. Like maybe that's still okay. And this is why you've got to look at your returns. So let's just say, that at the peak of the market, you could have sold a property for $600,000, but you've just missed it a little bit and the market's softened. And instead of selling it for $600,000, you can sell it for $550 or $500. If you bought that property for $250 or $300 and you're selling it for $500, that's still very good, right? So thinking about this stuff in context is really, really important. Not necessarily, did I nail the top perfectly? Understanding, does this still make sense in your portfolio to potentially sell, reallocate capital? Have you beat your hurdle rate? All of that kind of stuff. The other thing that I would say is that sometimes you're going to miss that optimal peak in a cycle. One of the things that Sean and I have been discussing, and yes, I'm deliberately going to try and wedge this into the episode, Sean, is the fact that market cycles appear to broadly be getting shorter. Everyone's laughing because they know what I'm going to say. But it does appear that market cycles are getting a little shorter. And the reason that started to kind of prick my ears up a little bit to me, or that I started to pay attention to it, is because some of the locations we started buying in 5 years ago are now displaying the signs again that we saw 5 years ago when they were right at the start of their cycle. And they've been through one cycle. We stopped buying there. Now we're going back to some of these locations. And I'm seeing this playing out in locations that we didn't select early on. But then in hindsight, we were like, oh, it would have been good if we did select that location. Now we're seeing those same signs again. And it's very interesting because what appears to be happening is the market cycles seem to be shortening. And, Sean kind of brought some thinking to the table around this, which I think is really, really relevant. And it's around that the greater ability for individuals to move capital between markets, or what I would call intranational capital flows. Because we've got investors who are now borderless investing. They're moving between different markets. They're reallocating capital in different markets. And so once upon a time, capital wouldn't move so aggressively and so deliberately around the country seeking returns. But now it actually is moving really, really quickly and freely around the country seeking those market returns. And so if you are sort of at a place in the cycle where you've got a property and maybe it doesn't make sense for you to sell, but also you're looking at the market and you're like, okay, it kind of looks like it's topping out. I guess my message would be, don't freak out. Like, that's probably still going to be okay. As long as you bought in a location which has good fundamentals, the fundamentals we look for to obviously cook down a very complex thing into something very simple: jobs, lifestyle, and affordability. So if the place is still desirable for people to live, if it's still a decent location, if it's got good fundamentals, maybe that's still going to be okay. And maybe it's only going to be a couple of years. And again, our personal experience with that, with Gabby and I, our second investment property, we bought the kind of one that the first good one that we bought. We actually bought it at the top of a cycle because we didn't realize we bought it at the top of a cycle. We still made money. Then we only waited a couple of years, and then it went through another surge. And then that was the one that I said was 600 grand 2 years ago. It's now 410, but now it's back at the start of a growth cycle to start shooting up again. And so once upon a time, you might have to wait 10 or 12 years between these growth spurts. But what appears to be starting to happen is in locations where there is still good relative local affordability, where there is still good lifestyle opportunities, and where there's still good economic opportunities, those cycles appear to be getting shorter and also potentially sharper, right? So they're potentially sharper upswings and shorter transitions between those points, or the same total growth over a shorter period of time. And I think that's a really interesting thing to consider as well, and a way to kind of take some of the kind of fear and panic out of this. Like, oh my God, do I need to sell? It's like, it's okay. Like, just slow down, calm your nervous system, turn off the amygdala. Everything's probably going to be just fine, right? And start to make calculated strategic decisions rather than reactionary emotional decisions. Even if you go and look at the data and you go, oh my God, this doesn't look great. So cool, chill. Everything's probably going to be fine. If you've bought in a good place, fundamentally, it's probably still going to work out just fine. So
beautiful.
Great.
We are at time. Guys, I think this is That's awesome. I really appreciate the effort we've all kind of put into sharing this, because I think it's like hoping that people are able to now make these decisions themselves. Again, if you want access to any of the tools that we pulled up today, the link is in the description, or if you're a client, you'll get sent the link as well. For all of the PDFs, put everything into spreadsheets as well, so you can work through and use them interactively as well. But yeah, thanks guys for joining us, and everyone live, thank you for joining us. If you're a client, thank you for being with us. Appreciate you. And guys, we'll see you next week.
Thank you, Gabby, for all the work you put in to pull this together. You did the lion's share of getting this ready with a real effort to help our clients. So thanks for all the work you put into it.
Of course, no worries. All right, thanks all.
See ya.
Hey guys.
See ya.
Don't hang up. Oh.